Hello and welcome to the market update on CBN Financial hosted by Uri. Let's dive into the highlights of this first week of September 2025. Global markets kicked off the week with a burst of optimism. Equity funds saw significant inflows, $65 billion globally, with European, Asian, and US funds leading the way. Technology sectors attracted nearly $1.9 billion, followed by financials and gold and precious metals. Bond funds also continued their winning streak, marking their 20th straight week of inflows, while commodity funds tied to gold reached their highest weekly intake since November 2021. Corporate borrowers pushed into the US bond market, raising almost $70 billion, well above expectations. This flurry of issuance included major deals like Merck's $6 billion raised to fund its acquisition of Verona Pharma and Cigna's $4 billion bond offering to refinance existing debt. Borrowing costs remain near historic lows thanks to tight spreads amid expectations of aggressive Fed easing. On Wall Street, stocks surged to record intraday highs Friday after a surprisingly soft August jobs report. Unemployment rose to 4.3%, sparking bets on a potential 50 basis point rate cut. Strong performances by tech giants like Broadcom, up 13% on robust revenue forecasts, helped push the S&P 500, DOW, and Nasdaq higher. Additional movers included real estate, housing stocks, Tesla on buzz around a $1 trillion CEO compensation plan, and Samsara with a 15% gain after beating Q2 estimates. Definitions and explanations for investors' stock market is where investors buy and sell ownership shares called stocks in publicly traded companies. Its level reflects how much investors expect companies to earn in the future, influenced by economic data, corporate earnings, and global events. When stocks rise, it's often because investors are optimistic about future growth or interest rates that make borrowing cheaper. Conversely, stocks fall when expectations dim, economic outlooks sour, or rates rise. Inflows like those into equity or bond funds signal investor demand. Heavy inflows into bond funds often suggest a flight to safety, while equity inflows indicate confidence in growth. Interest rates set by the Federal Reserve dictate the cost of borrowing. Lower rates generally boost investment and make stocks more appealing by reducing companies' financing costs and increasing consumption. Bond spreads, the difference between corporate bond yields and safer US Treasuries, reflect perceived credit risk. Narrower spreads indicate easier, cheaper corporate borrowing, often tied to optimism or central bank easing. When major indices like the S&P 500 reach record highs, it's typically a reflection of strong investor sentiment, expectations of economic expansion, or easy monetary conditions. As an investor, consider how sectors like technology, financials, or commodities align with your goals. Also, be mindful of risks.